Before we begin, please remember that I am not a licensed financial advisor, mortgage broker, or real estate attorney. This video is for informational and educational purposes only. The information presented here is not intended as financial, legal, or investment advice. Buying land and securing financing involves significant risk, and you should always conduct your own thorough research and consult with qualified professionals before making any decisions. All strategies and examples are illustrative and may not be suitable for your individual circumstances. You see it while you're scrolling online late at night. 5 acres, 10 acres, 40 acres, a patch of green on a map, nestled next to a state forest or overlooking a valley. And for a second you let yourself dream. You picture a small cabin, a long gravel driveway, a place where the only sound is the wind in the trees. You see the price and it feels attainable, feels possible. And then the dream slams into a wall of reality with one simple crushing question. How? How in the world do you actually buy that? It's not like buying a house. You can't just go on Zillow, click a button, and get pre-approved for a 30-year fixed mortgage on a plot of dirt and trees. The entire system, the entire financial world we live in, is built around financing houses, structures, buildings, things with plumbing and a roof. But raw land? That's the Wild West of real estate. And this information gap, this lack of a clear, simple path, is the single biggest reason why most people's dream of owning land remains just that, a dream. But what if I told you that financing land isn't actually that complicated? What if I told you the system only looks confusing because the people who understand it, the rural banks, the private lenders, the seasoned investors, don't exactly advertise the playbook? Today that changes. This is the guide I wish I had when I started. We are going to pull back the curtain and give you the step-by-step playbook for financing land in the United States. We're not just talking about theory, we're talking about the exact types of loans that exist, where to find them, and how to get approved. By the end of this, you will understand the landscape of land financing better than 99% of aspiring landowners out there. You will know exactly what steps to take to turn that late-night scroll into a signed deed. So first things first, we have to understand why it's so different. Why does a bank that will happily give you $500,000 for a suburban house get nervous about a $50,000 loan for 10 acres of beautiful woodland? The answer comes down to one word: risk. From a lender's perspective, a house is a known quantity. It's on a street, in a neighborhood with comparable sales or comps. They can easily determine its value. If you stop paying your mortgage, the bank knows they can foreclose, sell the house relatively quickly on the open market, and get their money back. It's a liquid asset. Raw land, on the other hand, is a completely different animal. It's illiquid. It can take months or even years to sell a piece of vacant land. There are often fewer buyers and its value is much more subjective. Is it buildable? Does it have road access? Does it have water and electricity nearby? Does the soil perk for a septic system? An underwriter sitting in an office 3 states away has no idea. To them, it's just an unpredictable, speculative asset. Their biggest fear is getting stuck with a piece of land they can't sell if you default on the loan. Furthermore, a house is collateral they understand. You live in it. You have a vested interest in maintaining it. With raw land, a lender worries you might just walk away if your plans fall through or if the market turns. There's less skin in the game, emotionally and financially. This higher perceived risk is why you can't just walk into a Bank of America and get a standard mortgage. They're not set up for it. Their entire business model is based on a high volume of standardized, low-risk home loans. A land loan requires specialized knowledge, a local touch, and a bigger appetite for risk. So knowing this, understanding the bank's fear, is your secret weapon. Because your entire goal when seeking a land loan is to de-risk the deal for the lender. You need to prove to them that you are not a speculator, that you have a solid plan, and that their investment in you is safe. How do you do that? You start by preparing a package that answers all their questions before they even ask them. This isn't just about your credit score and your income, though those are critically important. We'll get to the numbers, but first you need to master the story. What is the story of this land? What is your vision for it? Are you planning to build a primary residence in 2 years? A weekend cabin in 5? Are you going to use it for recreation, hunting, fishing, camping? Are you planning a small-scale farm? You need to have a clear, well-thought-out plan. A lender is far more likely to finance a 10-acre parcel for someone with architectural drawings for a future home, a quote from a well-digger, and a clear budget, than they are for someone who just says, "I don't know, it just seems like a nice piece of land." The plan is your proof of intent. It shows you've done your homework and are a serious, low-risk borrower. This leads to the most important mindset shift you must make. When you buy a house, you're a consumer. When you buy land, you have to think like a developer. Even if your development is just a tiny cabin and a vegetable garden, you have to approach it with the same level of due diligence. This means you need to become a local expert on that piece of property. You need to know about the zoning regulations. Can you build what you want to build? Are there restrictions? You need to understand access. Is there legal year-round road access? Or is it a seasonal dirt road that belongs to your neighbor? You need to investigate utilities. Where is the nearest power pole? How deep do you have to drill for a well in that area? What are the costs? Every piece of information you gather doesn't just help you make a smart purchase. It becomes ammunition for your loan application. You are building a business plan for your property, and that business plan is what you present to the lender. You are showing them, through meticulous research, that you have already reduced the risk. You've turned an unknown patch of dirt into a well-defined project with a clear path forward. Okay, so you've got your plan, you've done your due diligence. Where do you actually go for the money? Forget the big national banks. Your journey almost always begins at a local level. We're talking about community banks, farm credit services, and local credit unions. These are the institutions that are uniquely positioned to understand land loans. Why? Because they are part of the community. The loan officer might live just a few miles from the property you want to buy. They understand the local market, the local values, and the local regulations in a way a massive national chain never could. Their business isn't based on churning through thousands of identical mortgage applications. It's based on relationships. They often hold the loans on their own books instead of immediately selling them off, which means they have more flexibility in their underwriting. They can listen to your story. They can look at your plan and see the vision. If the president of the bank can drive by the property on his way home, you have a massive advantage. He's not just looking at numbers on a screen. He's looking at a piece of his own community. This is where you'll find what are often called portfolio loans. Loans the bank keeps in-house, giving them the freedom to make common-sense decisions that don't always fit into a neat little box. Your job is to find these local lenders and present them with your bulletproof plan, demonstrating that you are a responsible partner for their investment in the community. So, what exactly is a bulletproof plan? It's more than just a loan application with your name on it. Think of it as a business plan for your personal dream. You're not just asking for money. You're presenting an opportunity. You're showing the lender that you are a low-risk, high-reward partner who has thought through every single detail. This plan is your story, your evidence, and your secret weapon all rolled into one. It's what separates the amateurs from the serious land buyers. Let's break down the 4 pillars of this plan. The why, the what, the who, and the how. First, and most importantly, is the why. Why this specific piece of land? Lenders hear, "I just want some land all day long." That's a wish, not a plan. You need to paint a vivid picture for them, a picture they can see themselves investing in. If you plan to build your primary residence, your why is about creating a home for your family. You'll talk about the school district, the commute, the community. You'll say, "We've chosen this lot because it's the last one in a stable, developed neighborhood with all utilities at the road, and we plan to break ground within 6 months of closing." That's a story a community banker understands. If it's for a vacation cabin, your why is about escape and legacy. This property has direct access to the national forest. It's a prime spot for the rental market during hunting season, and it's a place our family will cherish for generations. See the difference? You're not just buying dirt. You're building an asset. If it's for recreational use, hunting, fishing, riding ATVs, your why is about passion and stewardship. You can talk about your plans for wildlife management, for improving the habitat, for being a responsible owner of a piece of your state's natural beauty. And if your plan is purely for investment or development, then your why is all about the numbers. You need to come armed with comparable sales or comps for similar parcels. You need to talk about the area's growth trajectory, upcoming infrastructure projects, or zoning changes that make this land a smart financial bet. Your passion is the projected ROI. The key is to tailor your why to the specific piece of land and present it with conviction. This is the heart of your pitch. Next up is the what. This is where you do your homework. The what is the nitty-gritty, objective truth about the property itself. This is the due diligence that proves you're not a starry-eyed dreamer who's about to buy a beautiful swamp. First on your list, a survey. You need a recent certified survey that clearly marks the boundary lines. Don't just trust the fence posts or the seller's friendly wave of the hand. You need to know exactly what you are buying down to the inch. This prevents devastatingly expensive disputes with neighbors down the road. Then, you need to become an expert on zoning and restrictions. Go to the county planning and zoning office. Ask them, what can I legally do with this land? Are there restrictions on the size or type of home you can build? Can you have livestock? Can you run a business from the property? Are there any covenants or deed restrictions from a previous owner that could derail your plans? Finding this out after you buy is a nightmare. Access is another huge one. Does the property have legal, deeded access from a public road? Or are you relying on a handshake agreement to use a neighbor's driveway? That handshake is worthless the moment that neighbor sells their property. You need to see the official plat maps and deeds to confirm your right to get to and from your own land. Physical access is just as important. A steep, washed-out dirt path might be fine for your 4x4 in July, but will a cement truck be able to get up there in March? And we can't forget utilities. This is a massive budget item. You need to get concrete answers. For electricity, call the local power company and ask for a quote to run service to your build site. It could be a few $1,000s or it could be $50,000. For water, will you need to drill a well? If so, talk to local well drillers. How deep do they typically have to go in that area? What's the cost per foot? For waste, the land needs to perk. A percolation test determines if the soil can absorb wastewater from a septic system. If the land fails the perk test, you may not be able to build on it at all. These aren't small details. They are potential deal breakers that you must investigate before you ever sit down with the lender. The third pillar is the who. The who is you. After you've proven the land is a good investment, you have to prove that you are a good investment. This is where your financial house needs to be in pristine order. Lenders are going to scrutinize you much more closely for a land loan than for a standard home mortgage. Why? Because if you default on a home loan, they can repossess a house, a relatively liquid asset. If you default on a land loan, they're stuck with a piece of raw land which can be much harder to sell. They are taking a bigger risk on you. So your credit score needs to be solid, typically higher than what's required for a home loan. You need to have a low debt-to-income ratio, showing that you have plenty of room in your budget to handle this new payment. You'll need to provide W-2s, tax returns for the last 2 years, pay stubs, and bank statements. They want to see a stable, reliable income and a history of responsible financial behavior. But the single biggest factor here is the down payment. Forget the 3% or 5% down you hear about for first-time home buyers. For a raw land loan, you should expect to put down a minimum of 20%, and it's very common for lenders to require 30%, 40%, or even 50%. This is the ultimate sign of commitment. It shows the lender you have serious skin in the game. If you've invested a huge chunk of your own cash, you're far less likely to walk away if things get tough. You need to be able to show the source of these funds, whether it's from savings, the sale of another asset, or a gift. Having a substantial down payment is non-negotiable. It's the price of admission for financing land. Finally, we have the how. This pillar ties everything together. It's your action plan. It's not enough to say, I plan to build a house. You need to show the lender how you're going to do it. Have you spoken with builders? Do you have quotes? Even better, do you have a specific builder you've chosen? Do you have a set of house plans, even if they're preliminary? Do you have a detailed, line-item budget for construction that accounts for everything from the foundation to the doorknobs? This level of preparation is what blows lenders away. It shows them you've moved beyond the dream stage and into the execution stage. It de-risks the project in their eyes because you're not a wild card. You're a project manager. You've anticipated the costs, you've assembled your team, and you have a clear roadmap from vacant lot to finished home. This is especially critical if you're planning to roll the land purchase and the construction costs into a single loan, which is a whole other topic we'll dive into later. So, you take your why, your what, your who, and your how, and you assemble it all into a professional loan proposal. A binder or a single PDF file with a cover letter stating your vision, followed by the property survey, the zoning documents, the perk test results, the utility quotes, your financial statements, your proof of down payment, and your builder's budget. You walk into that community bank not as someone asking for a handout, but as a serious partner presenting a well-researched, low-risk investment opportunity. This single act of preparation will put you in the top 1% of all land loan applicants. It tells the lender everything they need to know before they even run your credit. It tells them you're the kind of person they want to do business with. And now, with that pristine financial package in your hands, you've fundamentally changed the game. You're no longer just another applicant asking for money. You are a business partner presenting an opportunity. This is a critical mindset shift. You're not begging for a loan. You're inviting a lender to invest in a well-vetted, low-risk project with a highly organized partner. You. But which lender? And what kind of loan? This is where the path splits into a dozen different directions, and where most people get hopelessly lost. They hear a cocktail of confusing terms, get a few rejections from the wrong types of banks, and just give up, assuming their dream is impossible. It's not. They were just speaking the wrong language to the wrong people. So let's make you fluent. Before we even talk about specific loan products, you need to understand the single most important distinction in the world of land financing. It's the first question any lender will ask, and it changes everything about the deal. Is it raw land or improved land? Think of it from the lender's perspective. A loan on a house is relatively safe for them. It's a finished product. It has a kitchen, bathrooms, a roof. If you default, they can easily sell it to another family who wants to live in a house. It's a known quantity. Land is different. It's pure potential. And that potential is terrifying to a banker. Their entire job is to avoid risk, and a piece of dirt is a giant risky question mark. So, to reduce that risk, they classify it. First, you have raw land. This is the Wild West. This is land exactly as nature made it. No roads leading to it, no water lines, no electricity poles, no sewer or septic system. It might be heavily wooded on a steep slope or in a floodplain. To a lender, raw land isn't just a question mark. It's a gamble on a dream. They're not lending against a tangible asset. They're lending against your ability to one day, maybe, turn this wilderness into something valuable. Because of this massive risk, raw land loans are the toughest to get. The lenders who offer them are specialists. They're not your corner bank. And they protect themselves with some very specific terms. Expect to need a massive down payment. We're talking 30, 40, sometimes even 50%. Why? Because they need you to have serious skin in the game. If you've put down 50 grand of your own cash, you're far less likely to walk away if things get tough. The interest rates will also be higher than a mortgage, and the loan terms will be much shorter. You won't see a 30-year fixed loan on a piece of raw, inaccessible land. You're more likely to see a 3, 5, or 10-year loan, often with something called a balloon payment. That means you make smaller payments for a few years, and then the entire remaining balance is due all at once. The bank is essentially saying, "We'll give you a few years to get your act together and figure out what you're doing with this property, but we are not tying up our money in your undeveloped dream for the next 3 decades." It's tough, but it makes sense from their side. Now, on the other side of the spectrum, you have improved land. This is land that's one step closer to being a home. It's been tamed. It usually means the property has legal road access. It means utilities like water, electricity, and maybe even natural gas are available at the property line. The land has likely been surveyed, the boundaries are clearly marked, and maybe it's even had a perk test to prove a septic system can be installed. This is a completely different world for a lender. The risk has been drastically reduced. They're not gambling on a wild dream anymore. They're investing in a project that's already halfway there. Someone has already spent the time and money to lay the groundwork. It's a lot closer to that safe, predictable house loan they love so much. And because the risk is lower, the terms get much, much better. The down payment requirement drops significantly. You might be looking at 20 or 25% down, which is far more achievable for most people. The interest rates will be more competitive, closer to what you'd see for a traditional mortgage. And the loan terms get longer. You might find 15 or even 20-year loans for improved land, which makes the monthly payments much more manageable. There's no scary balloon payment looming in the future. So, your first job before you even talk to a lender is to identify what you're dealing with. Look at the property listing. Does it say utilities at the street? Is there a paved road leading to it? Has it been surveyed? Knowing whether you're shopping for a raw land loan or an improved land loan will instantly tell you what kind of terms to expect and which lenders to even bother talking to. But what if you could bypass the banks altogether? What if you could find a financing option that doesn't care about your credit score, your debt-to-income ratio, or that financial package you so carefully put together? This brings us to the third, and often most powerful type of land financing. It's a secret weapon that savvy land buyers have used for generations to get incredible deals with terms a bank would never dream of offering. It's called seller financing, or sometimes owner financing. The concept is brilliantly simple. Instead of going to a bank for a loan, the person who currently owns the land becomes your bank. You make a down payment directly to the seller, and then you make monthly payments to them with interest over an agreed-upon period of time. That's it. Now, your first question is probably, why on earth would a seller agree to do that? It's a great question. It seems like a lot of risk and hassle for them, but there are some incredibly compelling reasons for a seller to offer financing. First, it dramatically increases their pool of potential buyers. Suddenly, they're not just limited to cash buyers or people who can qualify for a difficult land loan. Anyone with a reasonable down payment is now a potential customer. Second, they can often sell the property for a higher price. Because they're offering the convenience of easy financing, they can command a premium. A buyer might be willing to pay a little more for the land if they don't have to go through the nightmare of a bank underwriting process. Third, it provides them with a steady stream of monthly income. For a retiree or someone looking for passive cash flow, getting a check in the mail every month for the next 10 years can be more attractive than getting one big lump sum of cash that they then have to figure out how to invest. And finally, there can be tax advantages for the seller by spreading out the income over several years instead of taking a single large capital gain. So for the right seller, it's a huge win. But for you, the buyer, it can be a life-changing opportunity. With seller financing, the rules are whatever you and the seller agree they are. You can negotiate the down payment, the interest rate, the length of the loan. Maybe you can't afford a 25% down payment, but you can do 15%. A bank would say no. A seller might say yes. Maybe you have a unique income situation that a bank's algorithm can't understand. The seller, a human being you can talk to, might get it. The closing process is also usually faster and cheaper, because you're cutting out the bank's lengthy underwriting and administrative fees. But, and this is a very big but, you have to be incredibly careful. When you do a deal with a bank, you're protected by a mountain of federal regulations and standardized paperwork. When you do a deal with an individual, you're relying on a private contract between the two of you. If you are ever going to consider seller financing, you absolutely must hire a real estate attorney to draft the paperwork. You need a formal promissory note that spells out the loan amount, the interest rate, the payment schedule, and what happens if you pay late. You also need a deed of trust or a mortgage, depending on your state, which is the legal document that secures the loan against the property and gets recorded publicly. Do not, under any circumstances, do this on a handshake or with a generic form you downloaded from the internet. The money you spend on an attorney to set this up correctly is the best insurance you will ever buy. It protects you, it protects the seller, and it makes sure your dream property doesn't turn into a legal nightmare down the road. So now you have the three main paths laid out in front of you. The high-hurdle, high-cost world of raw land loans. The more accessible, more affordable path of improved land loans. And the flexible, but potentially perilous, world of seller financing. Understanding these options is your strategic map. It allows you to look at a piece of land and immediately know what kind of financing it will likely require, and what kind of terms you can expect. But this map is useless if you don't know where the destinations are. Where do you actually find these lenders? Because I can promise you, it's almost never the big national bank on the corner. Asking them for a land loan is like walking into a seafood restaurant and ordering a steak. They might have one on the menu, but it's not what they do, and it's probably not going to be very good. You need to go to the specialists. You need to know where the real land lenders hang out. In the next part, we're going to uncover the three main types of institutions that actually love to lend money on land. We will pull back the curtain and show you exactly where to look and who to talk to so you can stop wasting your time and start getting approvals. Alright, let's start with the place everyone goes first, and the place you're most likely to get rejected, the big national bank. You walk into that familiar, polished lobby. The logo is on a dozen commercials you see every night. You feel like you're in good hands. You sit down with a loan officer who is incredibly sharp at selling 30-year fixed-rate mortgages for suburban houses. You mention you want to buy a 20-acre parcel of raw land, and you can literally see the confusion cloud their eyes. They start typing into their computer, clicking through screens they've never seen before. Their system is built for a 4-bedroom, 2-bath house with a picket fence. It asks for an appraisal of the structure, the age of the roof, the type of foundation. Your land has none of that. So the computer says no. And the loan officer, who has no power to override the system, just shrugs and apologizes. This is the fundamental misunderstanding. You're bringing a square peg to a round hole. You need to stop going to house lenders and start going to land lenders. The first and often best place to look is right in your own backyard. I'm talking about local community banks and credit unions. These are the hometown heroes of land financing. Think about it. The president of that bank probably lives just a few towns over. The chief loan officer might sit on the county planning commission. They don't just see your land as a set of coordinates on a map. They know that parcel. They know the family that owned it for 50 years. They know the new highway exit is planned a few miles away, and they understand its true local value in a way a computer algorithm in another state never could. The magic words you need to know are portfolio loan. A portfolio loan is a loan that the bank or credit union keeps on its own books, in its own portfolio. They don't sell it off to big secondary market investors like Fannie Mae or Freddie Mac. And why does that matter? Because it means they make their own rules. They aren't bound by the rigid one-size-fits-all guidelines that big national banks have to follow. When a local lender gives you a portfolio loan, they are making a personal bet on you and on the land in their community. They can use common sense. They can look at your unique situation, drive out to the property themselves, and make a human decision. Maybe you have a non-traditional income source. Maybe the property is in unusual shape. A big bank's computer would reject you instantly. A local portfolio lender can listen to your story, understand your vision, and say, "You know what? This makes sense. We'll do it." So how do you find them? Simpler than you think. Go to Google Maps and type in community bank or credit union for the county where the land is located. Make a list. Then start calling. When you get a loan officer on the phone, don't just ask, "Do you do land loans?" Ask the killer question. Do you offer in-house portfolio loans for raw land? That one question will immediately separate the lenders who can help you from those who can't. You'll be amazed at how quickly you can find a willing partner when you start speaking their language. Now, for the second type of institution, this one is the hidden giant of rural and land financing. It's a nationwide network that is responsible for a massive percentage of all farm and rural land loans in the United States. Yet many first-time buyers have never even heard of it. I'm talking about the Farm Credit System. The Farm Credit System is not a government agency. It's a network of privately owned cooperative lenders that was established by Congress over 100 years ago with a single mission: to provide a reliable source of credit for American agriculture and rural communities. Think of them as credit unions for the countryside. When you get a loan from a farm credit institution, you become a member owner. This isn't just a feel-good title. It means you share in the profits. At the end of a good year, they often pay out what's called a patronage dividend to their members. This is a real check mailed to you that is essentially a refund of a portion of the interest you paid all year. It can be a substantial amount, effectively lowering your real interest rate significantly. Can you imagine a big national bank ever sending you a check for being a great customer? It's unheard of. But the real power of the Farm Credit System is their expertise. This is all they do. Their loan officers, who are often called relationship managers, live and breathe rural real estate. They won't just finance your land, they'll walk it with you. They understand soil types, water rights, timber value, and zoning regulations. They can look at a 50-acre wooded lot and see not just trees, but a future home site, a managed woodlet for long-term income, and a prime spot for a pond. They get it. Because they are specialists, they offer loan products that are tailor-made for land buyers. They can offer longer amortization periods, stretching your payments out over 20 or even 30 years, which is rare for land loans. They can do interest-only payments for a period, which is a huge help if you need to spend your cash on initial improvements. They understand that you might want to buy a large parcel now and sell off smaller pieces later, and they can structure the loan with release clauses to allow for that. Finding your local farm credit lender is easy. They're divided into regional associations across the country, with names like Farm Credit Mid-America, Ag Country Farm Credit Services, or American Accredit. Just go to the National Farm Credit website and you'll find a locator tool. Put in the state or county of your property, and it will direct you to the exact association that serves your area. These are the people who are literally chartered to help you buy your piece of the American countryside. Finally, we have our third category, the Special Forces of Land Lending. These are the private specialty land lenders. These aren't banks or credit unions. They are private companies, often funded by investors, that have carved out a very specific niche: financing land and only land. They are the experts you call when the property is too weird, the timeline is too fast, or the situation is too complex for anyone else. Think of it this way: a bank is like a family doctor. They can handle most common problems. A farm credit lender is like an orthopedic surgeon. They specialize in the bones of the rural economy. A specialty land lender is like a trauma surgeon in the emergency room. They thrive on the difficult and the unusual. Is your property landlocked with only a deeded easement for access? Does it have a rare conservation easement that scares off traditional lenders? Are you an investor looking to buy a huge tract of timberland with a complex harvesting plan? These are the scenarios where specialty lenders shine. Because they aren't depository institutions, they are far less regulated. This gives them incredible flexibility. They can close a loan in a matter of days, not months. They can finance properties that have no utilities, no road frontage, nothing but raw potential. Their focus is purely on the collateral, the land itself. They have deep expertise in valuing land, and they're willing to take on risks that others won't. Now, this flexibility often comes at a price. Their interest rates and fees might be a bit higher than a local bank or farm credit, but they are providing a highly specialized service. They are pricing in the additional risk and the speed they provide. For many land buyers, paying a little extra for the certainty and speed of a specialty lender is more than worth it. They are the ones who can get the deal done when everyone else says no. Finding them often involves talking to land-focused real estate agents or searching online for terms like private land lender, raw land financing, or recreational land loans. So there you have it. The 3 keys to unlocking your land loan. The hometown heroes, your local community banks and credit unions with their powerful portfolio loans. The hidden giant, the farm credit system, the cooperative network designed for rural America. And the special forces, the private specialty lenders who can tackle the most complex deals. Your path to financing is no longer a shot in the dark. It's a clear strategy. You now know exactly where to look and what to ask for. But finding the right lender is only half the battle. The other half is showing up prepared. You can find the perfect lender, but if you walk in with a messy, incomplete application, you're still going to get a no. You need to present yourself as a low-risk, professional, and organized borrower they are excited to work with. So, how do you build that bulletproof application package? How do you transform yourself from just another name on a form into the kind of partner a lender is actively looking for? You do it by building what I call the lender's pitch deck. Forget thinking of this as a simple application. That's what amateurs do. You are not an amateur. You are preparing a professional proposal. This isn't just about asking for money. It's about presenting a compelling business case where you and the land are the central investment. You are selling the lender on 2 things simultaneously: the viability of the project and the reliability of the person behind it, you. Making their decision to say yes not just easy but obvious. This pitch deck is a comprehensive file that tells a complete story. It's organized, it's thorough, and it anticipates every question, doubt, or concern a loan officer or underwriter might have. It's divided into 2 primary sections: the story of you and the story of the land. Let's break down exactly what goes into each. First, the story of you. This is your financial biography. The lender wants to know: are you a reliable steward of capital? Do you have a history of meeting your obligations? Do you have the financial horsepower to not only make this purchase but also handle the unexpected? It all starts with your credit report. And I don't just mean the score. Yes, a high score is critical, but the story behind the score is what they're really reading. Pull your full credit reports from all 3 bureaus, Experian, Equifax, and TransUnion, well in advance. You can get them for free annually. Scour them for any errors, disputes, or old negative items that can be cleaned up. If you have a blemish, a late payment from 3 years ago, a medical collection you didn't know about, don't just hope they won't see it. They will. Instead, be prepared to explain it. Write a simple 1-page letter of explanation or LOX. This late payment on my car loan in June of 2021 was due to a bank processing error that has since been rectified. As you can see, all subsequent payments have been on time. This shows responsibility and foresight. You're controlling the narrative instead of letting them invent one. Next up is income verification. This is the engine of your financial life. For W-2 employees, this is straightforward: your last 2 years of W-2s, your most recent 30 days of pay stubs, and maybe your last 2 years of federal tax returns. But here's the pro tip. If you've had a significant pay raise recently, include the offer letter or a letter from your HR department confirming your new salary. Don't make the underwriter connect the dots between your old W-2 and your new, higher pay stub. Do it for them. If you're self-employed or a business owner, this section is even more crucial. You'll need at least 2 years of full business and personal tax returns, all pages, not just the summary. You'll also need a year-to-date profit and loss statement and a balance sheet for your business. The key here is consistency. Lenders average your income over 24 months. If your income jumped dramatically last year, be prepared to explain why it's sustainable. Was it a new business line? A huge client contract? Document it. Show them it wasn't a fluke. You're proving that your financial past is a reliable predictor of your future. Then we have assets. This is your proof of skin in the game. Lenders need to see where your down payment and closing costs are coming from. You'll need the last 2 to 3 months of statements for all asset accounts. Checking, savings, brokerage accounts, for 401ks, IRAs. Every single page, even the blank ones. Yes, it's a pain, but it's required. They are looking for 2 things: the source of the funds and the stability of your accounts. Any large, unusual deposits will raise a red flag for money laundering. A $50,000 deposit that isn't from your payroll needs to be sourced. Was it a gift from a relative? You'll need a signed gift letter and proof the money has left their account and entered yours. Was it the sale of a car or a boat? You'll need the bill of sale. Again, you are proactively answering the question before it's asked. Crucially, lenders also want to see reserves. Money left over after you close. Having 6 to 12 months of mortgage payments sitting in a savings account after the deal is done makes you look incredibly strong and reduces their perceived risk to near zero. Finally, you wrap up your personal story by calculating your own debt-to-income ratio, or DTI. This is the magic number for underwriters. It's all your monthly debt payments, mortgage, car loans, student loans, credit card minimums, divided by your gross monthly income. Most lenders have a hard ceiling around 43 to 45%. If your DTI with the new land payment will be 48%, you need to address that. Can you pay off a small credit card or a personal loan before applying to nudge that number down? Show them in your cover letter that you understand the numbers and have a plan. It proves you're financially savvy. Now, with your personal financial story perfectly documented, we move to the second, and arguably more important part of the pitch deck: the story of the land. A house loan is simple. The house is the collateral, and its value is well understood. Land is different. It's a blank canvas. The lender needs you to paint them a picture of a profitable, low-risk future. This begins with your vision, detailed in a land use plan. This is a 1 or 2 page document that is your secret weapon. What is your intention for this property? Don't just say, "I want to build a house." Be specific. My intention is to build a 2,500 square foot, 3-bedroom, 2-bath custom home for my family to use as our primary residence. Construction is planned to begin in the spring of 2025. If it's for recreation, describe it. This 40-acre parcel will be used for private family recreation, including hiking, camping, and hunting. No permanent structures are planned at this time, preserving the land's natural state. If it's an investment, you need a full-blown business plan. The property will be subdivided into 4 5-acre lots. Per current county zoning, we project a sale price of X per lot based on recent comparable sales, with a total project timeline of 18 months. You must back this vision up with hard evidence. This is your due diligence, and presenting it to them shows you've de-risked their investment. Include a copy of the county zoning map with your parcel highlighted. Provide the results of a perk test or a letter from the county health department stating the land is suitable for a septic system. Include a quote from a local well drilling company. If there's no public road access, include a copy of the recorded easement agreement. You are showing the lender that this isn't a pipe dream. You've confirmed you can legally and physically do what you say you're going to do. Next, include a preliminary budget and timeline. This doesn't have to be down to the penny, but it should be realistic. How much will the well and septic cost? The driveway? The initial site clearing? What's your estimated cost to build your home? Getting preliminary quotes from local contractors and including them in your package is a power move. It demonstrates that you understand the full financial scope of the project, not just the purchase price of the land. When you put all of this together, your meticulously organized financial history and your thoroughly researched plan for the land, you hand the lender a complete narrative. You've taken them on a journey. You've introduced them to a reliable, organized, and financially sound borrower. You've shown them a piece of land not as a risk, but as a well-defined opportunity. You have answered every question, addressed every potential concern, and eliminated any ambiguity. You've made their job simple. You've made it easy for them to stamp approved on your file. You've done the work, and now, the file goes from the loan officer's hands into the mysterious world of the underwriter. And that is where the final decision is truly made. So, who is this underwriter? Think of them as the final boss in a video game. They are the ultimate gatekeeper. They don't know you, they've never spoken to you, and frankly, they don't care about your dream of building a cabin in the woods. Their name is not on the door. They work for the bank, and their one and only job is to protect the bank's money. They are a risk analyst, a financial detective, and a policy enforcer all rolled into one. Your loan officer's job was to be your guide and advocate. The underwriter's job is to look at your file with a cold, impartial magnifying glass and ask one simple question. If we lend this person hundreds of thousands of dollars for this specific piece of dirt, what is the probability we will get our money back? To answer that question, they meticulously analyze your file through the lens of what the industry calls the 4 C's of credit. And understanding these 4 C's is the key to understanding the entire underwriting decision. The first and arguably most important C is capacity. This is the raw math. Do you have the capacity to repay this loan? They determine this primarily by looking at your debt-to-income ratio, or DTI. Imagine your monthly gross income, that's everything you make before taxes, is a big bucket of water. Every month you have fixed debt payments pouring out of that bucket. Your car payment, your student loans, your credit card minimums, and now the proposed monthly payment for this new land loan. DTI is simply the percentage of your monthly income that is being used to cover those debts. There are 2 numbers they look at. The first is the front-end ratio, which is just your proposed housing payment. In this case, the land loan payment, plus taxes and any insurance or HOA fees, divided by your gross monthly income. Lenders generally want to see this below 28 to 31%. The second, more critical number is the back-end ratio. This is all of your monthly debt obligations, including the new land loan, divided by your income. For most conventional land loans, underwriters want this number to be under 43%. If you're at 45, 50, or even higher, that's a massive red flag. It tells the underwriter that you are over-leveraged and that any small financial hiccup, a car repair, a medical bill, could put you on the path to defaulting on their loan. But capacity isn't just about the numbers. It's also about the stability and history of your income. If you're a W-2 employee who's been at the same company for 5 years with a steady salary, that's a green light. It's predictable. It's safe. If you're self-employed or a freelancer, the underwriter puts on their detective hat. They're going to want to see at least 2 years of tax returns. They'll average out your income over those 24 months to get a conservative, stable figure. They're looking for consistency. A huge jump in income last year looks great on paper, but to an underwriter, it's an anomaly until it's a proven trend. They need to be convinced that your income is not a fluke, but a reliable stream that will continue for years to come. The second C is capital. This is all about your skin in the game. How much of your own money are you putting into this deal? This includes your down payment and your reserves, the cash you'll have left over after closing. For a land loan, this is scrutinized far more than with a standard home loan. Why? Because a piece of raw land is considered a riskier, less liquid asset. If you default, it's harder for the bank to sell a vacant lot than a house. So, they want you to have a significant financial stake in the property. A large down payment, typically 20 to 35%, sometimes even 50% for certain types of land, proves 2 things to the underwriter. First, it shows you are financially disciplined. Second, it gives the bank a protective equity cushion right from the start. But it's not just about how much capital you have. It's about where it came from. Underwriters are required by federal law to source and season all large deposits. Seasoning means the money has been sitting in your account for a period of time, usually at least 60 days, proven by 2 months of bank statements. Sourcing means they know where it came from. A large, unexplainable cash deposit that appeared in your checking account last week is the reddest of red flags. Was it a loan from a friend you didn't disclose? Is it mattress money? To an underwriter, an unknown is a risk. They will demand a paper trail for every significant, non-payroll deposit. A gift from a relative? You'll need a signed gift letter and proof of the funds coming from the gifter's account. Sold a car? You'll need the bill of sale and a copy of the check. You have to prove, beyond a shadow of a doubt, that your capital is legitimate and unencumbered. The third C is credit. This is your financial report card. It tells the story of how you've handled debt in the past. The underwriter will pull a comprehensive report from all 3 major bureaus, and they are looking at far more than just your FICO score. A 780 score is great, but if that score is built on one credit card you've had for a year, it's not as strong as a 740 score built on a 15-year history of mortgages, auto loans, and responsible credit card use. They are dissecting your credit history. They look at your payment history first and foremost. Are there any late payments? A 30-day late payment from 2 years ago might be overlooked with a good explanation. A 60 or 90-day late payment in the last 12 months? That's a serious problem. It signals current financial distress. They look at your credit utilization. How much of your available credit are you using? If your credit cards are all maxed out, it suggests you're living on the financial edge. They look for public records, bankruptcies, foreclosures, judgments. These can be deal killers, or at the very least, require extensive waiting periods and letters of explanation. Every single line item on your credit report builds a portrait of your character as a borrower. Are you responsible? Do you honor your obligations? Your past behavior is the best predictor of your future performance. Finally, we arrive at the fourth and final C, collateral. This is the land itself. In a home loan, the collateral is simple, it's a house. In a land loan, the collateral is a complex puzzle the underwriter has to solve. The central document here is the appraisal. A licensed appraiser will visit the property, research comparable recent land sales in the area, and deliver a report with an estimated market value. If that value comes in at or above your purchase price, you've cleared the first hurdle. But the underwriter digs much deeper than the value. They are assessing the risk of the collateral. They're asking, is this a desirable, usable, and sellable piece of land? They will scrutinize the appraisal and title report for red flags. Does the property have legal, year-round access from a public road? Or is it landlocked? A landlocked parcel is nearly impossible to finance. What's the zoning? If you say you want to build a house, but the land is zoned for commercial or agricultural use only, the loan is dead on arrival. Are there utilities? Is electricity available at the lot line? Or is it 5 miles away? Does it have access to public water and sewer? Or will it require a well and septic system? If so, has a perk test been done to ensure the ground can even support a septic system? They will check for easements, encroachments, and deed restrictions that could limit your use of the property. Is the land in a flood zone? Does it have steep, unbuildable slopes? Is there any evidence of environmental contamination? The underwriter is trying to envision the worst-case scenario. If you stop paying, can the bank easily sell this property to get their money back? A flat, buildable 10-acre lot with road frontage and utilities in a growing area is A+ collateral. A steep, landlocked, 40-acre parcel in a floodplain with no utilities for miles is an underwriter's nightmare. After this exhaustive review of your capacity, capital, credit, and the collateral, the underwriter makes a decision. It's rarely a simple yes or no. The most common outcome is a conditional approval. This is great news. It means the underwriter is saying, I am prepared to approve this loan if you can provide me with the following items. These are called prior to doc or prior to funding conditions. It might be your most recent pay stub to verify employment, a letter explaining a recent credit inquiry, or proof that an old collection account has been paid off. Your loan officer will give you this list. You complete it quickly and accurately, the underwriter signs off, and you move toward closing. The other outcomes are a full approval, which is rare on the first pass, or a denial. If you get denied, the lender is legally required to tell you why. Maybe your DTI was too high, or a major issue was found with the property's title. This isn't the end. It's a roadmap. It tells you exactly what you need to fix before you try again. So you take that denial letter and you don't shred it. You don't burn it. You laminate it. You put it on your wall. Because that piece of paper is a personalized step-by-step guide to getting your land. If the reason was your debt-to-income ratio, the path is clear. You need to either increase your income or, more realistically, attack your existing debt. Pay down that credit card, get that car loan a little lower. Every dollar of debt you eliminate is a step closer to your dream property. If the issue was the property itself, maybe a messy title search revealed a long-lost heir has a claim, or there's a lien from a contractor who was never paid 30 years ago. That's not your failure. That's the system working for you. The lender just saved you from buying a legal nightmare. Now you know what needs to be cleared up with the seller before you can even think about moving forward. The denial is the guardrail that just kept you from driving off a cliff. So you regroup, you execute the plan laid out in that letter, and you reapply with a stronger case. But let's shift gears. Let's talk about the moment you've been working for. After all the paperwork, the waiting, the anxiety, you get the email or the phone call. The words you've been hoping for. You're approved. Let that sink in. That isn't just a financial transaction. That's a green light on a dream. It's the moment the abstract idea of owning land starts to feel real, tangible. It's the starting pistol for the final lap of this race. But right after that wave of relief, a new document arrives. It's one of the most important and most misunderstood pieces of paper in the entire process. It's called the loan estimate. Now, your first instinct might be to glance at the big number at the bottom and file it away. Do not do that. The loan estimate is your financial blueprint for the biggest purchase of your life. The government mandated this standardized, 3-page form to make it easier for you to understand the terms of your loan and to compare offers between different lenders. Understanding this document is not optional. It's your primary tool for avoiding surprises and hidden costs at the closing table. Let's break it down page by page. Page 1 is your high-level summary. It's the 30,000-foot view of your land mortgage. Right at the top, you'll see the loan terms. This section shows your total loan amount, your interest rate, and your estimated monthly principal and interest payment. A crucial thing to check here is the interest rate a fixed rate? For land loans, they often are, but you must confirm. A fixed rate means your principal and interest payment will not change for the entire life of the loan. It's your anchor in any economic storm. Right below that, you'll find the projected payments section. This is your estimated total monthly payment. It includes the principal and interest we just talked about, but it might also include an estimate for property taxes and homeowners insurance if you've chosen to have those escrowed. Escrow is basically a savings account managed by your lender. You pay a little extra each month, they hold on to it, and then they pay your tax and insurance bills for you when they're due. It's a way to break down big yearly expenses into manageable monthly chunks. Finally, at the bottom of page 1, you'll see the costs at closing. This gives you two big numbers: the estimated closing costs, which is the total of all the fees to finalize the loan, and the estimated cash to close. This second number is the one that really matters. Cash to close is the actual amount of money you need to bring to the closing table. It's your down payment, plus all those closing costs, minus any deposits you've already paid. Think of it as the final bill. No more estimates, no more projections. This is the check you'll have to write. Now for page 2. This is where the details live. It's a line-by-line breakdown of those estimated closing costs from page 1. It can look intimidating, like a page full of financial jargon, but it's actually organized into logical sections. Section A is origination charges. These are the fees your lender charges for creating the loan. This includes things like an application fee, an underwriting fee, which is the cost for them to verify all your financial information, and points. Discount points are fees you pay up front to the lender in exchange for a lower interest rate. 1 point typically costs 1% of your loan amount. You're essentially prepaying some of the interest. Whether this makes sense depends on how long you plan to own the land. Next is Section B, services you cannot shop for. These are third-party fees for services the lender requires, and they choose the provider. You don't get a say. This includes the appraisal fee, to make sure the land is worth what you're paying for it. It includes the credit report fee, and it might include a flood determination fee, to check if the property is in a flood zone. Since you can't shop around for these, your main job here is just to make sure the numbers match what you were told. But then comes Section C. This is the most important section on page 2 for any savvy buyer. Services you can shop for. This is your chance to save money. The lender will provide a list of approved companies for these services, but you are not required to use them. You can and should do your own research. What are these services? The big one is title services. This includes things like the title search, which is a deep dive into the property's history to make sure the seller has the legal right to sell it to you, and the lender's title insurance policy, which protects the lender in case any ownership issues pop up later. You can call different title companies and compare their fees. You might also see a survey fee here if one is required. Getting a survey done is almost always a good idea with raw land, so you know exactly where your property lines are. A few phone calls here could literally save you hundreds or even thousands of dollars. Page 3 wraps everything up. It shows you some key calculations and disclosures. The most important thing to look at here is the comparisons section. This is where you'll find your annual percentage rate, or APR. This is a number that trips a lot of people up. They see the APR is higher than the interest rate they were quoted and they panic. But it's supposed to be higher. Here's the difference in the simplest terms. Your interest rate is the cost of borrowing the money. The APR is the cost of borrowing the money plus most of the fees. The APR represents the all-in cost of your loan expressed as a yearly rate. It's a more accurate way to compare two different loan offers, because an offer with a super low interest rate might have sky-high fees, making its APR higher than another, more honest offer. The rest of page 3 includes other important details, like how much a late payment will cost you, and whether the lender intends to service the loan themselves or sell it to another company after closing. So you review every line of this loan estimate. You ask your loan officer questions about anything that seems unclear or incorrect. You shop around for the services in Section C. You get comfortable with the numbers. This document is your shield against last-minute surprises. Now, once you've accepted the terms and are officially cleared to close, you're going to receive a second very similar-looking document. This one is called the Closing Disclosure. The Closing Disclosure, or CD, is the final version of the loan estimate. The numbers on it should be very, very close to what was on your estimate. And here's a critical piece of consumer protection you need to know about. The law requires that you receive your closing disclosure at least 3 full business days before your scheduled closing date. This is called the 3-day review period. This isn't a suggestion, it's your right. It's designed to give you time to review all the final figures without being rushed or pressured at the closing table. If you find a significant error, or if the numbers are wildly different from your loan estimate, you have time to raise a flag and get it fixed. This 3-day window is your final chance to make sure everything is exactly as you agreed. You've navigated the application, you've survived the underwriting, and now you've dissected the financial documents. The final numbers are in front of you and they make sense. The money is ready. The date is set. All that's left is to sign on the dotted line. You're standing at the very threshold of land ownership. The journey is almost over. But the most legally significant event is still to come, the closing itself. What actually happens in that room? What are the dozen or so documents you're about to sign? And what do they legally commit you to? That final critical step is what we're breaking down next. You walk into a nondescript conference room. The air is still. On a polished table sits a stack of paper an inch thick, a testament to the journey you've been on. This is the closing table. It's the final exam, the summit, the last mile of a marathon you've been running for months. Every phone call, every email, every decision has led to this single moment in this stack of documents. For the next hour, you will sign your name more times than you have in the past year. But this isn't just about scribbling your signature. It's about understanding what you're signing. Because within these pages are promises, obligations, and legal chains that will bind you to this piece of land for decades. Let's pull back the curtain on this final ceremony. The main character at this table besides you is the closing agent, sometimes an attorney, sometimes an escrow officer. Their job is to be a neutral third party, to officiate the transfer of money and property, ensuring every I is dotted and T is crossed according to the law and the contract. Before you even sit down, you've already completed one of the most nerve-wracking steps: wiring your closing costs and down payment. This isn't like handing over a personal check. This is a large, verified, and irreversible transfer of funds from your bank to the title or escrow company's account. And the exact amount you need to wire is detailed on the single most important document you'll see today: the Closing Disclosure, or CD. This document is your financial Bible for the transaction. You should have received it at least 3 business days before closing by law. This isn't a suggestion. It's a federal requirement designed to protect you from last-minute surprises. Your mission, should you choose to accept it, is to compare this closing disclosure line by line with the loan estimate you received at the very beginning of this process. They should look remarkably similar. Think of the loan estimate as the initial quote for your land loan, and the closing disclosure as the final itemized bill. On page 1, you'll see the big numbers: the loan amount, the interest rate, the monthly principal and interest payment. Is the interest rate what you locked in? Is the loan term 10, 15, 20 years correct? If anything is different, you stop and you ask why. Now is the time for questions, not after your signature is dry on the page. Flip to page 2. This is the detailed breakdown of costs. You'll see loan costs like the origination fee your lender charged. You'll see other services like the appraisal fee, the credit report fee, the flood certification. You'll also see the costs associated with the title search, the lender's title insurance policy. Are these numbers what you expected? Some fees, like the appraisal, can't change much from the loan estimate. Others have a little more flexibility. But if you see a brand new 4-figure fee you've never heard of, you need to raise your hand and get an explanation. Further down, you'll find the prepaids, things like property taxes and any homeowners association dues you might need to pay in advance. The seller will be credited for any taxes they've already paid for the part of the year you will own the property, and you'll be debited. It's all about making sure everyone pays their fair share. Finally, at the bottom of page 3, you'll find the magic number: the cash to close. This is the final amount of money you need to bring to the table. This number is the culmination of your down payment, plus all those closing costs, minus any earnest money deposit you already paid. This is the figure you wired. It has to be exact. This document isn't a guideline. It's a ledger of the entire transaction, and you need to treat it with the respect it deserves. Once you've confirmed the numbers on the closing disclosure are correct, you'll be handed the next heavyweight champion of documents, the promissory note. If the closing disclosure is the bill, the promissory note is the IOU. But it's the most serious IOU will ever sign. This document is elegantly simple and brutally direct. It contains the core promise. It states that you, the borrower, promise to pay back the lender a specific amount of money at a specific interest rate over a specific period of time. That's it. It's your personal guarantee. It details what happens if you're late on a payment, the late fees. It details what happens if you fail to pay altogether, the dreaded default clause. Unlike other documents we'll discuss, the promissory note doesn't get filed in the public record. This is a private contract between you and the lender. It's the legal evidence of the debt. When you sign this, you are personally on the hook for hundreds of thousands of dollars. It's a sobering moment, and it should be. This piece of paper is the very reason the lender gave you the money. But the lender needs more than just your promise. They need security. They need a way to get their money back if you break that promise. And that brings us to the third and final member of the closing document trinity, the mortgage, or in many states, the deed of trust. These two documents serve the same fundamental purpose. They secure the loan to the property itself. They are the or else to the promissory note's promise. While the note is your personal IO, the mortgage or deed of trust is the document that says, if I fail to pay you back, you, the lender, have the legal right to force the sale of my land to get your money back. This is the foreclosure clause. This is what makes it a secured loan. The land is the security, the collateral. This document is what gets publicly recorded in the county records. It creates a lien against your property's title, which is a formal, public notice that the lender has a financial interest in your land. This lien stays on the property until the very last payment is made. When you finally pay off your loan years from now, the lender will record a satisfaction of mortgage or a deed of reconveyance, officially releasing the lien and giving you the property free and clear. So, to recap the big three, the closing disclosure is the final bill. The promissory note is your personal promise to pay. And the mortgage or deed of trust is what ties that promise directly to the land itself. After you've signed these, the rest of the documents, while still important, feel like the supporting cast. You'll sign the deed, which is the legal instrument that officially transfers the property from the seller to you. You'll see the title insurance policies, one protecting your lender, and the one you purchased protecting you, the owner, from any undiscovered claims on the property from the past. You might sign affidavits swearing that you are who you say you are, and that there are no other hidden liens or debts against the property that you know of. With each signature, the weight of the moment builds. The closing agent will methodically slide each page in front of you, point to the signature line, and you'll sign. And then it happens. The final document is signed. The agent gathers the paperwork, congratulates you, and slides a set of keys across the table. Or in the case of raw land, they hand you a copy of the recorded deed. The room, which felt so tense just an hour ago, suddenly feels light. You shake hands. You walk out of that conference room not as a buyer, not as an applicant, but as an owner. The land is yours. The debt is yours. The future is yours. But as you walk to your car, a new set of questions begins to bubble up. The deal is done, but the journey of ownership has just begun. The papers are signed, but what are the responsibilities that start tomorrow? How do you set up your first payment? Who do you notify about your change of address for property tax bills? What are the immediate, unglamorous, but absolutely critical first steps you need to take in the first 30 days of owning your new land to avoid costly mistakes? Because the truth is, a smooth closing is not the end of the story. It's just the end of the beginning. The moment you get those keys, or more accurately, that recorded deed, a clock starts ticking. This isn't a race, but it is a critical window of opportunity. The first thing you do within the first 72 hours is what I call the documentation and domination phase. First, documentation. You need to create a digital and a physical land Bible. Scan every single closing document, the survey, the title policy, the loan paperwork, everything. Upload it to a secure cloud service. Then, take the physical copies and put them in a fireproof safe or a safety deposit box. You might not look at these for years, but when you need them, you will need them desperately. This is non-negotiable. Second, domination. And I don't mean in an aggressive way. I mean establishing your presence. Make your first trip to the property as the official owner. This trip has a specific purpose. You're not there to dream, not yet. You're there to secure. If there's a gate, does the lock work? If not, replace it immediately. Walk the perimeter as best you can, using a GPS app on your phone that shows property lines. Post no trespassing signs at regular intervals, especially near any access points. This isn't just to keep people out, it's a legal step. In many states, properly posting your land strengthens your rights and limits your liability if someone gets hurt on your property. This first visit is about sending a clear, quiet signal. This land has a new attentive steward. Now moving into week 1. This is your admin and allies week. First, the admin. You need to call the county assessor's office and the tax office. Introduce yourself as the new owner of parcel number XYZ. Confirm they have the correct mailing address for you on file. The last thing you want is a tax bill going to the old owner and your property ending up in a tax sale because of a clerical error. It happens more than you think. If you plan to apply for any special land classifications, like agricultural or timber exemptions, ask about the deadlines and application process right now. These exemptions can save you thousands of dollars a year in property taxes, but the windows to apply are often very narrow. Next, and this is maybe the most important thing you'll do all month, meet your neighbors. Don't wait for them to find you. Go to them. A friendly introduction can be the single greatest asset you acquire. These people have been watching this land for years, maybe decades. They know its secrets. They know where the water pools after a heavy rain. They know which parts of the property the deer prefer in the winter. They know the local well driller who does good work and the one who doesn't. They are your ground-level intelligence. More than that, they are your first line of defense. A good neighbor will call you if they see a strange truck at your gate, or a curl of smoke where there shouldn't be one. You can't buy that kind of security. Don't show up empty-handed. A simple gesture, even just a handshake and a 5-minute chat, can pay dividends for the rest of your ownership. As you move into week 2 and 3, you enter the observation and orientation phase. This is where you resist the powerful urge to do something. Don't fire up the chainsaw, don't rent a bulldozer, don't even start clearing a campsite. Not yet. Your job right now is to learn the rhythm of your land. Visit the property at different times of day. See where the sun hits in the morning versus the afternoon. If it rains, go out the next day. Where are the puddles? Where does the water flow? That little gully you barely notice when it was dry might be a raging torrent after a thunderstorm. And that's something you want to know before you build a road or a shed there. During this phase, you become a cartographer of your own domain. Get a printed map of your survey and walk the land with it. Make notes directly on the map. Mark the location of significant trees, rock outcroppings, low spots, high spots, and areas with different types of vegetation. Take hundreds of photos and videos, narrating what you see. This is the northeast corner looking south. Lots of oak trees here, ground seems pretty solid. You are creating a baseline, a detailed before picture. This documentation is invaluable for planning, and will be incredible to look back on years from now. This is also when you physically identify your property corners if you can. The surveyor will have set iron pins. Finding them will give you a visceral, tangible sense of your boundaries that you can't get from a map. By the end of week 3, you've documented, you've secured, you've met the neighbors, and you've observed. Now and only now do you begin the prioritization and planning phase. Sit down with all your notes and photos. The goal here is not to create a master plan for the next 20 years. The goal is to answer one question. What is the one thing we need to accomplish in the next 6 months to make this land more useful and enjoyable for us? Maybe it's clearing a safe, accessible path from the gate to a beautiful spot where you can have a picnic. Maybe it's establishing a reliable, all-weather parking spot just inside the entrance so you don't get your truck stuck in the mud. Maybe it's hiring a forester to walk the property and help you create a basic health plan for your timber. The key is to pick one small, achievable goal. The biggest mistake new landowners make is getting overwhelmed by the sheer scale of the project. They want to build a cabin and a pond and a road system all at once, and they end up doing nothing. By picking one small, high-impact project, you create momentum. Completing that first project gives you the confidence and the energy to tackle the next one. This is how you turn a raw piece of land into your personal legacy. One small, intentional step at a time. Finally, in the last week of your first month, you begin building your bench. You're not hiring anyone yet, you're just making calls. You're building a list of the local professionals you will eventually need. Find out who the reputable excavation contractors are, who drills wells in the area, who installs septic systems. Call them. Introduce yourself, tell them you're a new landowner in the area, and that you're in the early planning stages. Ask them 2 simple questions. What's your average backlog right now? And what's a ballpark cost for a basic system or a day's work? You're accomplishing 2 critical things here. First, you're getting a realistic sense of timelines and costs. You might find out that the best well drillers are booked a year in advance, which is vital information for your long-term planning. Second, you're starting a relationship. When you do call them back in 6 months or a year ready to start, you're not a stranger. You're the person who called ahead, who was respectful of their time, who was planning responsibly. That puts you at the top of the list. So, after these first 30 days, what have you accomplished? You've secured your asset, you've established yourself in the community, you've learned the unique personality of your land, you've created an achievable short-term plan, and you've built a roster of local experts. You haven't moved a mountain of dirt or built a single thing, but you have laid a foundation of knowledge and preparation that is more valuable than any physical structure. You've survived the first 30 days, you have a plan, and you've made your first mark. But this is where the real journey begins. The long-term success of your land ownership isn't just about this initial sprint. It's about the marathon. It's about avoiding the sophomore slump of land ownership, where initial excitement fades and costly long-term mistakes are made. What are the 7 deadly sins of new landowners that can turn your dream property into a financial nightmare over the next 5 years? We'll break them down next. The first and most common sin is the sin of blissful ignorance. This is the belief that because you own the land, you can do whatever you want with it. You picture a charming tiny home, a small workshop for your business, maybe even a couple of rental cabins for extra income. You close the deal, you pop the champagne, and then you call the county planning office to get your permits. That's when the dream shatters. The voice on the other end of the line calmly informs you that your property is zoned agricultural residential 5, which means the minimum dwelling size is 1,200 square feet, commercial businesses are prohibited, and you can't have more than 1 home on the parcel. Your tiny home dream? Illegal. Your business plan? Dead. Your rental cabins? A fantasy. This single mistake has turned more dream properties into frustrating, expensive prisons than any other. The cure is painfully simple. Before you even make an offer, call the county planning and zoning department. Give them the parcel number and ask them, what can I do here, and more importantly, what can't I do? Get the answers in writing. Don't take the seller's or the realtor's word for it. Your entire future on that land depends on this one phone call. The second deadly sin is the sin of the empty wallet. This is underestimating the monumental cost of turning raw land into a place you can actually live. You budget every penny for the down payment and the monthly mortgage. You feel proud, but the land itself is just the entry fee. It's the cover charge for the club. The real costs are inside. How are you getting water? A well can cost anywhere from $10,000 to over $50,000, depending on depth and geology, with no guarantee they'll even hit water. How are you handling waste? A standard septic system install starts around $15,000 and can easily double if the soil is tricky. How are you getting power? If the nearest utility pole is a quarter-mile away, the electric company could hand you a bill for $30,000, $40,000, or even $60,000 just to run the line. And what about the driveway? A simple gravel road can cost thousands, a paved one tens of thousands. New landowners get so focused on buying the land, they forget they also have to buy the infrastructure. The solution is to make your due diligence period a fact-finding mission for your wallet. Get real quotes, not ballpark estimates, for a well, septic, power connection, and a driveway. Add those numbers up. If that total makes you sick to your stomach, you cannot afford this property even if the land itself seems cheap. This leads directly to the third sin, the sin of the impassable path. You find a gorgeous remote parcel online for a steal. The pictures show epic views and total seclusion. You're sold. What you don't realize is that the road to get there is a seasonal dirt track that turns into an impassable mud pit for 4 months of the year. Or worse, you discover the property is landlocked. This means there is no legal deeded access. The path you used to visit the property is actually an informal trail across your neighbor's land, and the day after you close, he puts up a gate and a no trespassing sign. Your land is now an island you can't reach. You're facing either a legal battle to force an easement, which can take years and cost a fortune, or trying to convince a hostile neighbor to sell you a strip of their property. Suddenly, your cheap land is the most expensive mistake you've ever made. To avoid this nightmare, you must verify access with the same intensity you verify the title. It needs to be illegally recorded, deeded easement that specifies year-round access. If the road is private, you need to understand the maintenance agreement. Who pays for plowing and grading? Drive the route yourself, preferably in a regular car, not a souped-up 4x4. If you can't get there easily, you've found a beautiful prison, not a paradise. The fourth sin underpins all the others. The sin of the rushed signature. This is the disease of deal fever. The seller says they have another offer, the market is hot, and you have to act now. So you get swept up in the emotion and start waiving contingencies to make your offer more attractive. You waive the survey, only to find out 5 years later that your entire garden and the corner of your shed are on your neighbor's property. You waive the perk test to save a few $100, only to discover the soil is pure clay and won't support a septic system, making the land unbuildable. You skip a thorough title search, only to learn there's an old mineral rights claim on your land, and an energy company has the right to start drilling on your front lawn. These are not exaggerated horror stories. They happen every single day. The cure is discipline. Your due diligence period is a sacred, non-negotiable window to protect yourself. Never let a seller or an agent rush you through it. A good deal will still be a good deal in 30 days if it's meant to be. A bad deal disguised as a good one will fall apart under scrutiny. Let it. Patience is the ultimate defense against a decade of regret. Next, the fifth sin, the one that sneaks up on you every single year. The sin of the surprise bill. You look at the current property taxes for the 50-acre parcel you want to buy, and they're only $400 a year. Amazing! You factor that into your budget and close the deal. Then, a year later, a bill arrives in the mail from the county assessor for $7,000. What happened? The previous owner was a farmer who had the land under an agricultural exemption, or a timber exemption, which drastically lowered the taxable value. The moment you bought it and declared your intent to build a home, that exemption vanished. The county reassessed the land at its highest and best use fair market value, and your tax liability exploded by over 1,500%. This can be the difference between comfortably affording your land and being forced to sell it. The antidote is simple. During your due diligence, call the county tax assessor. Ask them, what would the estimated annual property taxes be for this parcel if it were sold at my offer price, with no exemptions? This gives you the real number, the true cost of ownership you need to budget for year after year. The sixth sin is one people feel awkward about, but it's critically important. The sin of the hostile border. You're buying land for peace and quiet, to get away from it all. You focus so much on the land itself that you completely ignore the people on the other side of the fence line. You never stop to talk to them. After you move in, you discover the neighbor to the north likes to practice with his heavy metal band in his garage every Saturday. The neighbor to the west has 4 dogs that bark incessantly day and night. And the neighbor to the south has plans to subdivide their 100 acres into 20 different lots, destroying your pristine view and quiet solitude. Your peaceful sanctuary is now surrounded by noise and conflict. You can't choose your family, but you absolutely can, and should choose your neighbors when buying rural land. The solution is to get out of your car. Knock on their doors before you buy. Introduce yourself, say you're considering buying the property next door, and ask them what they love about the area and what the challenges are. You'll learn more in a 15-minute conversation than you ever will from a property listing. It's an interview for the rest of your life. Don't skip it. Finally, the seventh deadly sin. The sin of the forgotten dream. This is buying a piece of land without a clear written long-term plan. The idea is vague. We'll build our dream house. Someday, it'll be a great investment. We'll use it for camping on the weekends. But someday never comes. 5 years pass. The land is overgrown with weeds. The property taxes keep coming. The initial excitement has worn off, replaced by a quiet sense of obligation. It's no longer a dream, it's a burden. It's just a line item in your budget that you have to drive 2 hours to go mow. The dream dies from a lack of direction. To avoid this, you must treat the purchase like you're starting a business. Write down a 1-year, a 5-year, and a 10-year plan. What is the primary purpose of this land? What specific measurable steps will you take each year to move toward that purpose? This written plan becomes your North Star. It keeps you focused, it keeps you motivated, and it turns a piece of dirt into a tangible legacy. Financing the land is just gaining entry to the arena. Avoiding these 7 sins is how you win the fight. It's the difference between a story of triumph and a cautionary tale. This isn't about scaring you away from your dream. It's about arming you with the foresight to build it on a foundation of rock, not sand. You have the knowledge now. You understand the financing, the due diligence, and the long-term pitfalls. You are not just buying dirt. You are taking the first step in building a future, a sanctuary, a legacy. Now go do it right.